I would say that in general, when you compare emerging economies to developed economies, the things that characterize them generally, and the World Bank warning was to specific EM countries, but as a generic comparison of EM to developed, the things that distinguish emerging economies is lower debt levels, higher reserves, more independent central banks that view it as part of their mandate to focus on inflation, to stand up to the banking system and to stand up to finance ministries. So in general, I think the situation in EM is a pretty healthy one on that metric relative to developed markets. Having said that, there are some countries that have built up high levels of corporate debt and that have a high rate of debt or that have a high rate of debt accumulation. The Bank for International Settlements has also been highlighting that. But even those measures show that the increases in corporate debt, for example, are very similar to developed market levels. So although I think there are some countries in the emerging world that could be captured by the general statement that the World Bank made, and also that don't necessarily fit the overall EM situation. But in general, low debt, high reserves, independent central banks is pretty hard to argue with. Moreover, my reaction as a manager of an unconstrained EM bond fund is if a country has a problem and you're not getting paid enough for that risk, don't own it. And this gets into the right way to do EM bonds, and I think one of the right ways is to make sure that the size of your fund is appropriate to the opportunity. If our fund was beyond a certain size, I would perhaps I would refuse it and close the fund, but I think you would have to do things that you'd have to maybe start getting involved in some of those countries that maybe you shouldn't. I'm very concerned about corporates, and I'm mainly concerned about the issue you alluded to, which is their illiquidity. In the situations you mentioned Brazil, you mentioned China, I would throw in Russia, I would throw in any energy sector name. You had dramatic price declines relative to the news. So for example, there's an investment grade company in the oil sector in Colombia, which had $1 billion credit line from one of the big U.S. banks, and it dropped roughly 50 points in price because investors just didn't want to own anything that had energy or oil in it. And so I think those specific cases that you mentioned that I added to tell you that illiquidity, or confirm this idea that illiquidity is a risk. Overall, we have not seen that risk manifest. So these have been isolated cases, but I think they're part of a mosaic that's developing. Why have we not seen this manifest itself in a big way? Because there haven't been outflows. There have not been outflows from big EM funds, most of which have significant corporate exposures. So no one ever really had to sell on a broader basis. If you think that there will continue to be no outflows from bond funds, even in a rising rate environment, if we have one, I'm not saying we will, probably will, then everything's fine. If you think there may be outflows or that's a risk, then the downside that could come about due to the illiquidity of a number of EM corporates, I think is much, much higher than what the upside warrants. So we are avoiding corporates with only two exceptions. One is if the illiquidity risk is priced in, we're okay with it. We were invested in Petrobras. We've since closed it, but we were invested in Petrobras when the crisis was happening because it was very hard for us to argue that the illiquidity premium wasn't already in there. Everybody sold. There's a big short base, in fact. And so there are a few companies where we feel that there's already a significant illiquidity premium in there, and so we're less worried about it. But that's basic. That's the one basic category of corporates where we're comfortable, but it's really an exception. And the other is really high-rated, safe, liquid corporates where we feel like where we think we're making more than we know we're making more than cash. Cash these days basically earns you 0 to negative. So those are the two types of corporates that we have. We're really focused, obviously, on the first on the first sector where the illiquidity premium is already in there, where it's hard to argue that why you're supposed to be worried about illiquidity. It's already happened. But it's still a small percentage of our overall portfolio, and we're pretty concerned. The way it resolves for us may be in a rolling way. It may not be that we get the headline, corporates sell off. I actually think it probably will happen that way, but it's possible that it happens in the rolling way that it has for us. Namely, we like Brazil for a while because the illiquidity premium goes in, and then finally it's attractive to us. Or in the other names, like the ones that we have now, where it gets priced in, then it rallies, and we get out, and we see other opportunities. But I think if you do see outflows from funds, I think corporates you could see the first scenario where corporates sell off is a broader theme.